Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Alex Baluta from Flow Capital back for an update. Flow Capital trades on the TSX Venture Exchange under the symbol FW. Company is currently trading at 49 cents with roughly 31 million shares outstanding, or about a $15 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trev. Yeah, it's always good to sort of get back in contact with some of the groups that we've chatted with in the past. Alex, I think it was October of last year that we last talked. You're a student and an animal in the market here, like we are. We've seen quite the markets the last couple months here, and I think it's a very opportune time to get back to talk to you, find out how Flow is doing, find out what you guys are seeing out there in the market. But before we jump into that, why don't we just remind everybody what Flow Capital is all about?
Sure. Thank you, Paul. Thank you, Trevor. I'm going to share my screen here in a second. It's interesting you mentioned these dangerous, difficult markets. On a relative basis across almost every single asset class that I track, we are the best performer. And I know it sounds silly, but our stock hasn't moved. It should go higher, but it hasn't gone down. I look at the large cap techs. One of the best performing large cap techs is Apple, and it's down 30. The rest of the sector is probably down on average 55, and some of these really, really good companies are down 80. And so it is, and it seems to be, I've dabbled in some small cap mining stories and other things. Just as a background, I've got a history about, as a top ranked Wall Street analyst, did it in Bay Street, covered tech, was always listening to the mining guys about what some of their stories were or other tech stories. And so I've got a history of small cap investing. And it just seems like across the board, every sector is down, including crypto, which you'd figure in an environment of inflation might be the one place you could hide. So it's, we're doing our best to get the word out there, but to be honest, I'm proud of the performance of our stock. And frankly, it's because we've had a pretty phenomenal run over the last, since we've been here 7 months ago, and there's more to come. So let me do exactly as you suggested. I'm going to share my screen. Can you see my screen?
We sure can.
Okay. I'll go through a kind of an abridged overview of what we do, and I have a slide towards the end that just says, here's some of the highlights. Frankly, mostly our press releases from the last 7 months, but each one of them highlights sort of a core part of our strategy, and it's worth pointing out. So we lend money. We're an alternate capital provider. We lend money to high growth tech, primarily tech companies. And so they'll use our capital to help extend existing runways so that they can postpone a dilutive equity round. And if you're a company growing at 30 or 40%, your equity value is growing at least at that amount. And you might be seeing multiple expansion, notwithstanding the current market that we just discussed. But if you're a high growth company, the cost of your equity is in the mid to high double digits. The cost of our capital is in the mid to low double digits, not even mid to, I should say low double digits. And so as long as the nominal cost of our capital, call it 15, 16%, is lower than your nominal growth rate. So if you're growing faster than the cost of our capital, if you're growing at 22% and our cost is 15, you should always take my money from a comparison of the cost of our capital versus the cost of equity. And we're a lender, so we sit at the top of the stack. But let me go through very quickly some of the highlights, the obligatory. This is disclaimer slide. The numbers I'm giving you are from Q4, which we reported. It was a really good year. Q1 is coming out shortly, but everything in here is publicly digestible and fully disclosed. So we're a lender. We've deployed over $125 million now since we started, over 60 deals. 18 are currently active. And what's unique about us, you've had some of our comparable companies on, like Tamaya, for example. What we do is we take warrant positions in almost every one of our deals. In fact, since I've been here for over 3.5 years, every one of our investments, we've gotten a version of a warrant, either a warrant or a bonus on exit, type structure with every one of our deals. And so what that means is we're not just a yield play, we're a yield senior secured top of stack with equity upside play. And that's actually something that not a lot of people can say. Amazing board, always worth pointing out. Catherine, lead independent director on Kinross, Alan Torrey, took Morneau Chappelle from 100 million to 2 billion. He's on the board of Extendicare. Michael Zich was the global head of fixed income at Scotiabank. Vernon Lobo has his own family office, 2-time successful venture capitalist. These are individuals who are on our board. They're way overpowered, relatively speaking, to our market cap, but they're here because they believe in our opportunity and the future and what we're trying to build here. And so what we do is we lend money to high growth companies, as I said earlier. And what we give you, the investors, is access to a diversified portfolio of sometimes smaller but high growth companies. So you don't have to take one-off risk. You invest with us and we give you that diversified portfolio through primarily a debt structure with equity upside. Parameters, I won't spend a lot of time on this, but these are revenue generating companies, no startups, no early stage companies. We don't do real estate. We don't do resources. We do almost exclusively tech, not primarily tech. Sort of over 80% of our portfolio is tech, and they're all revenue generating. And of that, over 65% of our portfolio is SaaS, software as a service, i.e. recurring revenue. Just a quick snapshot of our portfolio. You can see that on our website. So we lend money. Our business model is we generate cash revenue or royalty income from high growth companies. Now, we play in a segment called venture debt or growth debt, over $20 billion a year in originations. In fact, one of the largest players now in the space is CIBC Innovation Banking. They bought Wellington Financial, which did the same thing we do, and they've grown that into billions and billions and billions of dollars of tech-based investment per year. Over 40% of venture deals take a sliver of venture debt alongside. And so we fill that gap between banks, which are not good at investing in high growth, low asset companies, and dilutive equity financing, either through the capital markets or through venture capitalists themselves. We see over 1,000 deals per year, and in every one of our deals, we're senior secured. Very, very rarely are we in a second position. So we're senior secured debt. And this is important. A lot of your investors, our investors, will understand real estate. They've invested in mix or elsewhere. They'll talk about loan to value of 50, 60, 80%. The loan to value, the representation of our loan relative to the total equity value of the company, is generally in the single digits, 4, 5, 6%. Rarely over 10%, and we won't go above 20. I haven't done that for a long time. So that gives you a lot of protection in equity, even in challenging markets like you're seeing today. And then the key point is we participate in equity upside through warrants, and I'll focus on that a little bit more in the presentation. And look, very quickly, we love growth companies. We get downside protection because of the loan to value I just talked about. Lots of exit alternatives. All these high growth companies have a lot of exit alternatives, and we get warrant upside. So we're publicly traded, proven model, proven team. In 2021, we did 6 million in revenue, over 3 million in adjusted EBITDA, and over $1.5 million in free cash flow. So we are generating returns for our shareholders. We're trading at below tangible book, and we're generating positive free cash flow. That's a hard mix. You don't often see that. And so for every incremental dollar we invest, our ROE is approaching 40%. It's well over 30. So if I invest $1, I'm making a significant return every year. We have 23 million in equity attributable to common shareholders. It's now 25. That's been disclosed in a press release. We had a fantastic exit, which I'll talk about in a minute, and that added over $2 million in aggregate to our balance sheet equity. And importantly, we're aligned with you, our shareholders. On a fully diluted basis, we own 26% of the common equity of the company. That includes the board and management and employees. So just very quickly, this is a snapshot of our revenue. The white is our quarterly revenue. You'll see a dip here, and you might say, well, why did revenue go from 1.6 to 1.2? And that's because between Q2 and Q3, we had 5 exits last year, 5 successful repayments. Obviously, if we're not deployed, we're not earning interest income. Then by Q4, we redeployed almost all that capital and then some. The dark line shows you EBITDA, and the light green line shows you recurring cash flow. So We have a long track record of stability in terms of our performance and free cash flow, and we ourselves are in growth mode now. Won't talk about the financials. Here's the slide I think you wanted me to get to. What is the update since our last pitch to you? So in November, we invested $1.5 million in a company called Covo Health Tech Solutions. Following that, we did a US $2 million investment in a company called Ask Vet. That company, if you have a pet, if any of you have a pet, a dog primarily, you will very likely have bought your dog what's called a Kong, K-O-N-G, a Kong toy, a dog toy. It's one of the largest dog toy companies in the world. That company, which is a very large company, has made a strategic investment in Ask Vet post our investment, which you'll see in a lot of our deals where there'll be an equity co-invest. Over here, Everwash secured a $6 million Series V follow-on equity investment at $100 million after we had put our money into that transaction. So you'll see that a lot, is that we're not in there naked or alone. We're often seeing either we demand equity co-invest or the companies continue to go on and invest equity and we get to stay on invested. So Everwash acquired a technology company called OmniX. That was great news. Minilux, one of our investments, went public on the TSX. You know, that company, I don't know what the valuation is now, but it had over $150 million market cap, over 20 million in cash. We're the only debt on the balance sheet at $2.5 million. Very strong, I would argue, secured position. We put an additional $1.5 million into Jorsex. So we'll often do that. We'll tranche investments. I'll have a slide I'll show you where we put in $1 million, watch them perform, put in another 2 million, watch them perform, put in another 3 million. So we just did that in EchoBox, one of our longest and most successful deals. We're now into it for $6 million US. When we first put in money, they were doing 2.5 million in revenue. Now they're doing over 8 million in annual recurring software revenue. And we get the opportunity to continue to invest in that entity in a senior secured debt structure. Our financial numbers for 2021 were great. Book value of 75 cents per share, a year-over-year growth of 33.7% in our book value. Over 9 quarters, that's up 60%, almost a double. Well, we just had another 9% gain, which I'll talk about in a second. That's this announcement down here. Post the end of last year, we had a company called Performio that, let me explain this one. We put in $3 million US in a senior note in June of 2021. Company valued its equity at the time at about $26 million. They continue to perform phenomenally well. They did an equity investment that represented a change of control, which triggered in this case, we had a buyout provision, a success on exit provision. We put in $3 million. After repayment of that principal in less than a year, we had a net aggregate $2.1 million gain, all in the span of 10 months. That buyout represented a 9% gain in book value per share for our shareholders. Put that into perspective, I had more gains in book value on that exit than some of my competitors have attributable to common shareholders in aggregate. And I had that on one exit. So we had a great year. We were up over 60% in 9 quarters in book value. It's now even higher with the exit of Performio. And the rest of our metrics have been growing. And so, you know, Paul, I came here last year. We talked about our strategy. We talked about investing in high growth companies. And I think that, you know, investors are like, okay, show me. First, I've heard the deal. Yeah, you're profitable. You got a great board. You're performing. And, you know, here we are having these kind of years and having these kind of exits. And frankly, I'm very proud of myself and the team for putting together these kind of numbers. And so that's where I'll just do a quick summary slide and then maybe hand it back to you, Paul. Look, we're public, high disclosure, threshold of disclosures, you might imagine. I mentioned our strong board, mentioned our ownership, mentioned our revenue and free cash flow capabilities, strong return on equity, strong growth in book value in a very, very big space. And we're a tiny, tiny player in a big space, which is where I want to be. And we're poised to continue to grow. As we deploy more capital, you're going to see us become a growth story, both in terms of our free cash flow generation, and then importantly, in that equity participation that we get through every one of our investments today. So let me pause there, Paul, and hand it back to you.
You got it. Perfect. Great. Thanks, Alex. I want to remind everybody that's listening, if you've got any questions you want me to ask Alex, please just use the chat function, and I'll do my best to ask the question. Look, I mean, congratulations on a great year. I mean, this certainly, the last sort of 6 months haven't been a treat for the equity markets. And I think we can go back to about a year and a half to the top of the market. So anybody who's performing like this, I think is certainly doing something right in the space. Let's now look forward a little bit. I mean, what sort of capital do you have access to now to continue to do business? And then let's talk a little bit about what the pipeline kind of looks like in this environment.
Sure. Capital, because of the Performio buyout and a couple of other initiatives that we have underway, we have, I'm going to say roughly about $10 million Canadian right now to deploy, or will soon have. I think we have 6 or so million Canadian, not including the reserves and everything else. So that's free cash available for investment. So just with available cash, or soon to be available cash on the balance sheet, we have the capacity to do another 2 $4 million US investments, or 2 $5 million Canadian investments, which, at 15% interest generates $1.5 million Canadian interest per year. And given that we're already profitable, all that'll flow to the bottom line. In terms of the pipeline, I have another slide in here. Let me get to it quickly. These are our numbers, our pipeline numbers for 2021. To be honest, we spent a lot of time since I got here almost 4 years ago now, focusing on what I call our superpower, which is deal origination, due diligence, all those things. Those are important. But what's really important is seeing the best quality deals and the most of them that you can possibly see. And that's hard. So in 2020, we did 861 deals or leads, closed on 3 of them. So very low close rate. 2021, we saw almost 1,000 deals, closed on 6 new and 2 extensions. So 8 deals altogether, still below 1% close rate. I personally, that tells you how picky we are in terms of the types of deals that we want to do. And that's kind of a number that we're trending at for this year. We're trying to grow the top of the funnel. So the simple, if I have, I'd rather invest in 9.9s out of 10 than 9.6s or 8.9s out of 10. And that's a function of just having choice. And so it's about building our lead referral networks. That's a big one. Where do we, the VCs that we talk to, the lawyers that we talk to, the investment bankers that we talk to. And we've done a lot of work in the last couple of years on paid digital advertising and digital marketing, and building up our brand and building up our content and trying to target those entrepreneurs. And we've done a good job. So we have a lot of deals in our pipeline. I will be at some point in the near future capital constrained, still profitable, but we're working on a lot of initiatives, as you might imagine, to try and grow our capital base non-dilutively in the current market. And I think we'll be successful over the next couple of quarters at, having more visibility to accessible capital to continue to grow our business.
Mm-hmm. Now, like we talked about, the equity markets have been riled up for a bit in the last little while. So traditional equity is a little bit harder to come by. What does that do for you guys? I mean, it must increase the number of opportunities you're looking at, and sort of to some degree make you considerably more competitive than equity.
Yeah, absolutely, Paul. That's exactly right. In fact, this week we started focusing on 2 things. One, let's reach out to a lot of the investment bankers in Canada and the US and look for deals and relationships that they have that need capital, that we can fill that gap because they can't raise equity today. The other thing that you'll see a lot of is there's a lot of stories now about how VCs are battening down the hatches. They're going to all of their portfolio companies and saying, well, one, we're gonna cull the herd and focus on our best. And by best, we mean the ones that are most judicious use of capital. So it's no longer growth at all costs in the VC world. It's about, okay, pretend you're not going to get money for the next 2 years. You need to cut your costs and right size your business to make sure that the capital that you have helps you grow through this uncertain funding window. Now, it's cyclical. We've been here before, but in both the scenarios I just described, closed capital markets and closed venture markets, that represents a great opportunity for us to see deals. Now it's incumbent upon us to make sure that we're picking the right deals, but that's why we have a 1% close rate, right? We see a lot of deals. We want to make sure that companies that have sustainable competitive advantage. One of the other slides I have is how much effort we put into due diligence. I mean, we'll take anywhere from 6 weeks to 3 months to close a deal. Management often comes to me and says, okay, how quickly can we close the deal? And my response is, how ready are you? Do you have your financials? Do you have your audits? Do you have all the information that we look for and the metrics and the analysis and the customer calls? And if you have it ready, we can close relatively quickly. And that means 6 to 8 weeks. If you're not ready, we'll be demanding information and you'll be preparing it and getting it ready. And it's a 3-month process. So this isn't the way we invest. It's not about you're a pitch, put $3 million US to work. This is about really doing, and if you look at the background of both the board members and most of the management partners, team members, we ask equity risk questions to understand the equity viability of the company, because if the equity takes care of itself, we're for sure going to be taken care of as that senior secured piece in the capital stack. Mm-hmm. So bad markets, closed financial markets, to answer your question in a roundabout way, is generally very good for us. And the responsibility, our responsibility is, as it always is, to make good investment decisions. Mm-hmm.
Now, Alex, we're now starting to live in an environment of rising interest rates. How does that affect your business? How does that affect your sort of competitiveness with your capital?
Yeah, it's a great question. So our current sources of capital are not floating, they're fixed, which is good. So we don't have any risk on that side. We expect that over time, as we move to more senior strategic partners helping us grow our business, there will be a component of floating fees in there. It's not up to me to I'm never going to guess where interest rates are going or aren't going. And so what we do is we try to cap that as best we can within a range. So for floating, for example. And then on our side, we're adding, though in many of our portfolios, the durations aren't that long, many of our investments, we're changing our structure a little bit to include a floating component above what used to be, let's say, above LIBOR 3. LIBOR is not in use anymore, but above LIBOR 3 will float with the market. It'll provide us a little bit of protection against drastic moves in funding. So to answer that question, one, we have a relatively short duration on the remaining portfolio, and our sources are not floating right now, so I don't think we have any risk. Two, we're in our future deals building in a component of variability to provide us some protection above a hurdle rate. And I think the negotiation points there are, what's that hurdle rate? But we've seen it. We're taking it. We're paying attention to it, and we're adjusting appropriately.
Now you're a tech expert. I mean, that's where you really cut your teeth as an analyst. When you're looking at the markets right now and you're seeing kind of the downfall of some of the big tech names and things like that, what do you see that's working? Like what part of the space, if any, is working? And then ideally, what companies that you guys are invested in are you the most excited about?
That is a really good question. Look, I remember, and you asked that same question the last time. I'm a fundamental believer that tech is, we are living through a unique transitional event in the fundamental nature of our economies towards technology solutions in all aspects. Through COVID, which was an interesting kind of a kickstart to what's happening, maybe not a kickstart, but a case study, the revenues of our portfolio companies grew by over 55%. In other words, the revenue growth accelerated. Now that was over, almost 2 years ago now when that started. But that trend towards technology solutions to solve everyday problems is bigger than an inflationary cycle, is bigger than a recessionary cycle. I really do believe it, it's been going on. You can peg it from Internet 1.0, you can peg it from, if you remember, Y2K, and it's continued on since then. And ironic, the iPhone didn't exist 10 years ago, maybe 11, I can't remember the exact number, but think of the change that we've seen just in that relatively short period of time, and that's going to continue. So we're, and I kind of hate using the terms, but we're kind of riding the long-term wave of technology's infiltration into the world, into our economies, into our digital lives, into our home lives. And I just don't see that ever stopping. So you asked, which companies do I love? Well, we did an investment in a company called Everwash. Everwash is a software platform that enables subscriptions for car washes. There are the largest player to date in terms of owning assets and sort of a growth play in car washes is a company called Mr. Car Wash. Went public last year at about 6 or 7 billion, a little down, but it's got about 300, 400 car washes. 72% of their customers are on a subscription plan. That's 400 units, i.e. car washes. There's 67,000 units in North America in terms of car wash locations. And Everwash is the platform solution for all the rest of that. Not all of them, but most of them. They've got hundreds of units, millions of subscribers, and they sell subscriptions to car washes. And as a car wash, if you can start seeing visibility into 10, 15, 20% of your revenue, rain or shine, that gives you a lot more comfort in your business model. And they charge a relatively modest amount against the car washes. And so that's a technology solution that they help car washes get members, and they help see visibility for car washes, and they get massive growth potential. Great company, kind of leading the space, still relatively small, almost 80 million in aggregate revenue, net revenue, which is what we care about, not just flow through revenue. It's approaching 10 million. We've got 6 million invested. They just did an equity round for another 6 million in equity at $100 million free. And our warrants in that company are now have a strike price of 80 million. Kind of that's what I like to be. Those are the kind of deals we look for. And they're out there. It just, that's why we work on pipeline development and funnel. And then, Paul, when these guys exit, my warrant position represents on average about 1.5 to 2% of all of the companies that we invest in. So they're 5-year, 6-year term, sometimes 10. So imagine a couple of years down the road, we're right. Everwash is really successful and it's $1 billion exit. Well, there's a fairly meaningful return for our shareholders that's attributable to book value. And let me just give you a quick idea of this is our portfolio as of Q4. $36 million invested, generating over 6 million in revenue. Here's our equity and warrant position. I'm not giving you the exact names just because you know who they are. I'm just not going to identify each one of them. But we have $2.2 million in warrants. And again, this is audited by or reviewed by us, reviewed by our auditor, and a third-party auditor every year goes through. It's basically 3 sets of eyes on the valuations, and we really, it's got to be a big hurdle achieved for us to move them up. And this was the exit, the compensation management software company that we just exited. We had, instead of warrants, we had this 1.5% exit fee on exit. It just had happened very quickly, but those are the types of gains that these warrant positions represent. And as we get to 20 and 30 and 40 live investments, we'll have cycled. Look at it this way. Every time we invest $1 million, we earn warrants to the tune of somewhere between $200,000 and $400,000 worth of warrants. And we recycle that $1 million now. One of the additional things that we're doing in this higher inflationary environment is shortening our term. So from 4 years to 3 years down to 2 years, so that we don't have as much exposure later on. But we recycle. Every time we recycle, we earn $250,000 worth of warrants at every one of our companies for every $1 million I invest every 30 months, let's say on average. That's going to build a really big warrant portfolio, and not all of them are going to work. Some of them, like you see here, are going to be zeros, maybe for the time being, or maybe forever. But a meaningful number of these warrants are going to hit, and if we have even reasonable returns like we just had, we're going to have long-term equity appreciation over and above the profitability of our company.
Alex, what challenges is the business face?
Deal flow. 2 things right now is deal flow and sourcing of capital. So we have capital right now, but for me, it's always a long-term vision. I'm looking for a strategic funding partner. We ourselves, we feel the pain of the equity markets. although our stock is relatively outperformed, it's still below book value, so we would never raise equity here. But it would be, continue to see great deal flow, and then, find that strategic partner who's going to help us go from 40 million in assets to 240 million in assets. And we can do that without really dramatically increasing our costs. We're already profitable, and what you'll see is a significant improvement, even over and above the great return on equity we're having now, as we scale our business. So we're, I feel, at an inflection point where we're not diversifying. We're not going out and buying specialty finance companies here and there. We're laser focused on funding high growth companies, primarily tech, and we're going to stay focused on that with our core structures. And we're just going to grow our asset base. It's a $20 billion market, and we're less than a fraction of 1% of that today.
Listen, thinking longer term, like companies like yourselves, you tend to trade at a discount to net asset value, but longer term, investors that aren't really experienced with these type of businesses, how do you sort of recapture that discount? Is there any tools that you guys have over the long term that capture 100% of the value?
Yeah, I think that I think everybody, especially in this environment, it's a challenge. I think what we're long-term believers in is, well, first of all, management and employees are fully aligned with our shareholders. So my long-term, not only do I own equity, but my long-term compensation plan, I may have mentioned this last time, but my hurdles are based on share price of $1, $2, $3, and free cash flow of $2, $2 million, $5 million, $8 million. And that'll be, we'll raise. So I need to generate positive free cash flow against my net tangible book. And I think that when I'm putting down hypothetically 10 or 15 cents of free cash flow, I think shareholders are going to recognize that. And then down the road, we can pay a dividend. We can figure out ways to get money back into shareholders' pockets. I personally like to reinvest my capital because I can generate better returns for shareholders when I get $1 back, by putting that dollar out, making more warrants, etc. But as we grow, we will consider all options to improve shareholder value. If that means share buybacks, we'll do that. If that means dividend paying on commons, we'll do that. But we're believers that if we keep executing as we have, keep generating that free cash flow, that we will be generating more free cash flow per share than some of the leading operating companies out there. And we believe that shareholders will take advantage. We'll recognize that. It's a hard answer, but that's how we believe. And we've aligned ourselves from our returns as shareholders in that vision.
And I gotta mention, I mean, this is me thinking out loud a little bit, but you're sort of managing a 30% plus type of return. At some point, if the stock gets discounted more than that, it might make more sense to buy back the stock than it is to use that capital. So there's sort of a floor, if anything, on kind of where the stock should be.
So that's a great point, Paul. If I could just give you a number, we had a couple of years ago, we had 44 million shares outstanding. We're down to 31.
Okay, wow.
That's us buying as my chairman likes to say, we're buying dollars for 50 cents. Yeah. And that value is accruing to our shareholders. Now, we can't do that forever, but when there's a significant discount, I'll do that all day because I know the quality of our portfolio, and that will be accretive to shareholders.
Yeah, and look, I mean, that's one thing that I say to a lot of our members is that you want to be investing in businesses that at least have that backstop, right? The ability to buy back the stock if it's cheap. And that only comes from generating cash, right? You've got to have cash and generate cash to be able to do that. So there's especially in this environment, there's very little financing risk when you're sitting on a lot of cash and you're making money.
That's right.
Right. So good for you guys. Okay. Well, listen. I mean, this is a pretty, as far as I'm concerned, pretty easy story to tell. You guys are doing a great job in generating returns. You guys have a lot of deal flow right now, probably more than you've seen in a long time because of the environment. You're collecting interest. You're sort of getting paid while you wait for some of your equity upside. It's a pretty, a few things that people are kind of looking for in this environment. So good for you guys. But any, like, as investors standing on the sidelines here watching, what should we really be paying attention to, whether that's a catalyst or certain metrics that we can see that are telling us that you're continuing to grow the business in the right direction?
Yeah. So look, we did another one. So we had the 9% gain in book value from the exit of Performio. As I mentioned, that was a $2.1 million gain in less than a year. We had another buyout of a small royalty. That was about a $300,000-ish gain. That was a very old royalty that bought out. So you'll see. So if you think about it, we've only started taking warrants in the last 2-3 years. And many of those warrants still have a 5-6 year life. But eventually, I'm going to have a warrant portfolio that's large enough that I'll start seeing regular cadence of exits in those warrants. That's the objective. Maybe quarterly, one exit, maybe once every half year. But those will be catalysts that'll be completely unforecastable. You just know that over time, as I have a big enough portfolio, if we're doing our job, we'll have those. So we'll have $1 million equity gain there. We'll have a $3 million equity gain here. And so those are catalysts that, as much as I'd love to say, a regular cadence, I can't promise that, but I can tell you that as we get enough of them, we'll start getting a somewhat more regular cadence. The other thing is just, we're laser focused on generating free cash flow. And so if I'm notwithstanding quarterly variations, like I showed you here, we had 5 exits all at the same time. Well, of course, my revenue is going to come down because I had a balance sheet full of cash and I had to redeploy that capital. But as soon as I did, my revenues go back up. So there's some variation on a quarterly basis, but the longer term trend should be, as capital comes in, if we're building up our pipeline and we have the sources, we should be redeploying. And I want to be in a position where I'm always just a little bit short of capital, so that I'm always fully deployed. Yeah. And I'll tell you, one of the things we didn't do and haven't done, we repaid in the last 3 years, I believe, $22 million in traditional debentures. Never missed a payment, paid them all back. And I don't like debentures because when I get a big whack of cash, I have a bunch of it sitting there not working for me. Right. Then I have to redeploy it. And then at the end of the deployment period, I have to hoard it in order to pay back the debenture. So at either end, I'm not making a return on a bunch of capital sitting on my balance sheet. That's just a dumb way to run your business. Yeah. Now, I may have to do that or make it stagger them. And you look at some of the larger players, BDCs, for example, in the US, not BDC Canada, but the Business Development Corp in the US, they've got staggered maturities. And we'll get there over time. But there's a lot of things that I can do, but I'm just focused on growing our revenue, growing our portfolio. One of the things we do comes from another friend of mine in the business. We target 0 zeros. We target 0 defaults as best we can. Now, the losses we'll make will be more than made up by the gains in our equity positions, but it's so much easier to run this business when things are going smoothly. And so we target 0 zeros, we target growth, we target free cash flow. And I think that the market will eventually recognize it. I need to get out there more, tell the story more. But as you said, the story is relatively simple. Find good companies, grow with them, get bought out, recycle, hold that warrant position, do it again.
And like, again, you're studying the markets like all of us are. Where do you think we are in these markets? Especially because you got a little bit more leaning towards technology. The capital markets, are we going lower? Are we going higher? Are we staying still? Is small better than big? Is big better than small?
Like everybody, I'll take a bit of, I'll punt on
that. Yeah. What's your best guess?
Yeah. So we saw a chart one of my team members shared the other day that price to revenue valuations on forward 12-month revenues had reached like 50, not 1.5, which itself is high, but 50 on some of the software plays out there. And they've since recovered to about 8.8 times. And actually that sounds high, obviously a lot better than it was, but it's actually not that bad for high growth companies. I mean, maybe it can come down a little bit more, down into the 7s. So I think a lot of the correction, it's another reason I'm glad I'm not in equity. And I don't mean broadly in equity like capital markets, public markets, but just broadly, I'm glad I'm not an equity investor. What's fundamentally the difference between us and a venture capitalist is a venture capitalist will have 20 or 30% of his portfolio pay for the other 70 that didn't work. We don't do that. 100% of our portfolio has to pay for itself. And then we have some additional upside in the warrants to protect us. But I think that the valuation correction that, when you go from 50 to 8, that's a pretty meaningful correction in a very short period of time. So I think most of the pain has been felt. If I put my analyst hat on from 20 years ago, I would look for those companies now that have a real differentiable, maybe that's not a word, differentiation in their value proposition to their customers, recurring revenues. So for example, Netflix, I still love Netflix. As a user, I haven't looked at the financials, and maybe it's overdone. Whereas, on something like Tesla, again, just use a big name, is it really worth the equivalent of 10 other car makers in aggregate? Maybe. It's a hard one. So I don't play that game. I just look at, is this a great company, great group of management, really has a defensible marketplace? The other thing we look for, and I think this works for investors as well, consistency in the way they present their numbers. So if you're going to tell me I'm going to grow my business by 10 million next year, and I ask you just some very high level questions about the number of salespeople you have, your on target earnings, and how often your salespeople hit those earnings, and your numbers on the numbers of salespeople comes out to 6 million at fully on target, but you're focusing on 10, you're not going to make it. So as an analyst, I look for those kind of consistencies in, does it make even rule of thumb sense? Now, I recognize some investors don't have the luxury of doing that. But those are the things that I look for: is good management, defendable marketplace, reasonable valuation, even if it's high. 8 times revenue is still high, but are they growing at 44%, 82%? Well, those companies are growing to their valuations very quickly.
Yeah, absolutely. Well, listen, we're sort of at the end here, and is there anything that I didn't ask you that I should have, or is there any key message you want everybody to walk away with today?
No, first of all, I really appreciate what you do, the service you provide. We need more voices in the small cap wilderness, so thank you for that. And I appreciate the opportunity. And I would say to the potential investors, just look, we'll keep delivering the way we're delivering, and hopefully we can have you on board as shareholders, because we're all about generating shareholder value. So I appreciate the opportunity, and maybe we can touch base again in 6 months.
Well, absolutely. We look forward to that. Listen, congratulations on a great 6-7 months since we last spoke, and definitely we look forward to catching up with you sort of in the next 6 months. So we've been speaking with Alex Baluta, CEO of Flow Capital. Symbol is FW on the Venture Exchange. Thanks for joining us today. It was a pleasure, and always fun to catch up. So looking forward to the next time.
Thank you, Paul. Thank you, Trevor. And thank you, everybody else.
Cheers.